Beware the self-directed sleeve inside your employer plan, particularly if someone in the financial services industry recommends that you do that. Beware of that. We're going to talk about why and how that actually plays out in real life later on in the program. Also, we're going to talk a little bit about some tax moves to do prior to the end of the year. Hard to believe. Here we are racing to the end of the third quarter. That means we've only got 3 months left in the year before it's 2023. So we got some tax moves that we want to discuss with y'all, and maybe they might apply to you. Anytime you can save money on your taxes, especially with all this inflation stuff going on, well, then that's always a good thing. So welcome to the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Central Florida is the longest-running radio program, also one of the top 25 financial planning podcasts on the World Wide Web. So make sure you subscribe to us on your favorite social media or podcast platform of choice. Have any trouble finding our channel, go to our website, Nelson Financial Planning, and there you will find a bunch of icons in the upper right-hand corner. Click on the one that looks most familiar to you, and there you go. You'll be instantly connected to our channel on those particular platforms. My name, of course, Joel Garris. I'm a certified financial planner, also a certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. So, before we get into all that, certainly we have to talk about the week that was. A choppy week, to say the least, in terms of what the markets were doing on a daily basis, particularly the decline on, what day was that? Tuesday of this past week. It really caught attention. And I think at the end of the day, it's along the same lines as what we've been talking about for quite some time on this radio show and podcast, is that we have a battle between inflation and interest rates going on as we speak. And what's happening there is that this past week, inflation sort of got the upper hand. It sort of won that round, if you will, because I think the markets had started to maybe think, hey, maybe this inflation stuff is going to dissipate a little bit. Maybe it's coming a little bit more back under control, and maybe the Federal Reserve doesn't have to raise interest rates as aggressively. Shoot, maybe they might even start cutting interest rates next year. And I think based upon the data that came out this past week, that certainly was not the case. Remember, the markets generally don't like higher interest rates, nor for that matter should you, because it increases the cost of borrowing. So whether you are a consumer and have a mortgage, or trying to get a mortgage, or have credit card debt, or want to go out and buy a car and get a car loan, the reality is that all of those are ultimately, the costs of those are going to go up. And so as that cost goes up, obviously that impacts your wallet. And it doesn't matter whether you're a consumer or a business for that matter, because if you're a business trying to finance a particular project, or maybe a factory or an inventory or whatever the case may be, then those costs also go up. So this volatility, we don't think is necessarily disappearing anytime soon. The causes of this high inflation, well, we've certainly talked about those before. Don't necessarily need to belabor them on this week's show, but obviously excess government spending, right? A lot of stimulus put into the economy, not just by our government, but governments around the world. Inflation is not just a problem that is unique to here in America, but it is something that's happening all around the world. Certainly a lot of governments did a lot of stimulus spending in response to COVID that arguably, in hindsight, certainly did not need to do quite as much as was done, perhaps not even nearly as much as what was done. Some estimates say that government spending over the course of the past 3 years has contributed to about half of this inflation soup that we are in now. The Federal Reserve obviously was slow to react, and so consequently they're having to make up lost ground with these interest rate increases, widely expected to raise rates again next week or this coming week. And ultimately, that may be even 1 full percentage point. So that's a pretty significant job that they're doing. But again, they're having to play catch up because remember, the economy is just beginning to see the first rate cut that they did back in March. Because anytime you cut rates, it's not like it has an instantaneous impact in the economy. It takes time for those to work their way into the economic system. So the impact of those, or the benefit, if you will, of those higher interest rates really takes about 6 to 9 months to really sort of start to have an impact in the economy. And so right now, we're barely starting to see sort of that first rate hike. And then lastly, obviously the global supply chain issues, particularly in China, and its a strict adherence to its policies involving COVID and sort of almost like a zero tolerance policy. We're reading the statistics that we saw just recently on that, and it looks like if you look at the amount of districts in China that have, or cities with districts that have full or partial mobility restrictions, climbed to the equivalent of 37% of China's GDP. Let me say that number again. So basically, about a third of the economy, as represented by population centers in China, is under some form or experiencing some form of mobility restrictions as a result of COVID. Can you imagine that? Imagine how much that creates an issue in the global supply chain, particularly since, pretty much everything comes from China. So anyway, our advice, obviously, keep your head down, keep your arms and legs in the vehicle at all times. This is going to be a little bit of a bumpy ride going forward. Not a particularly great time to start making big investment decisions or changes or things like that in reaction to the headline. History tells us again and again that that's a really bad thing to do. And so consequently, it's important that you do things like listen to this show, for example, in order to get perspective on what's happening out there and where may be the investing opportunities. We at Nelson Financial Planning for 30 plus years now have been holding a series of exclusive events for our clients at Nelson Financial Planning with the intent of sort of providing perspective in and good solid information. We have these sessions as sort of a once a quarter kind of thing. And so in the next segment, we're going to talk about the most recent one we had just this past week, share some of the insights that we shared with our clients at that event. Coming up next here on Dollars and Cents. So we're talking a little bit about some of the information that we shared with our clients at Nelson Financial Planning this past week at one of our exclusive events that we've been holding for our clients of the firm for well over 30 years now. Every quarter, we like to have an opportunity for folks to gather together and get some good information, get some good perspective on exactly what is going on out there. Sort of separate out the craziness that the media likes to kind of push and talk about what's going on in the economy and investments. And to that end, we usually bring in a speaker. Sometimes it's local speakers like Dr. Sean Snaith, who is out there at UCF. Other times it's folks that come in from all over the country. Last night's speaker, or this past week's speaker, was actually from Chicago. And usually it's an economist, or it's an investment person, or it's somebody that's got a number of years in the industry that can help come and chat and talk a little bit about some of the things to be thinking about from an investment perspective. Because as we were saying in the last segment, now's not the time where you just kind of throw up your hands and say, all right, I'm going to change everything that I'm doing from an investment perspective. Because the reality is that these things, these times, these events always fade into the background. But if you overreact from an investment perspective, well, then so too will your investment results fade, because history tells us time and time again that you certainly don't want to go making big changes in reaction to the headlines, regardless of what those headlines are. So, as we were saying, every quarter for almost over 30 years now, we've been having these types of events for our clients. And so we thought it would be good to share with our listening audience here on the radio show and podcast exactly kind of some of the things and some of the concepts that were shared this past week with our clients. See, if you're a client of the firm, you get this information ahead of time. But if you're not, then you have to wait to the program. Anyway, number one, there are still signs of growth as recovery from COVID continues. You know, it's interesting. The speaker that we had this past week, it was one of the first times they had been in the field, if you will. Some companies, we forget here in Florida that there's a lot of companies, a lot of businesses that are just kind of getting people back into the swing of things 2 years after sort of the COVID shutdown all happened. A lot of companies are still in the process of sort of reopening themselves for business. So there's still that part of the recovery, right? You kind of saw that with some other economic data that came out this past week in terms of retail sales continuing to go up, because again, you're still having that recovery. And particularly if you start to look at some of the industries out there that are finding themselves to be more relied upon, like cloud computing, those types of industries are seeing giant growth rates. Healthcare, pharmaceuticals, all of those types of areas are seeing some tremendous opportunities for future growth. Interestingly, mining companies as well, because as we move more to this electric and side of things and away from sort of coal and other types of and oil and other types of energy, well, then what it's going to require is that the electric grid has to get updated, and the batteries that are used to power all of these electrical items and need to have certain materials like cobalt and iron and everything else that is required. So you have a lot of people that then are mining for those materials. Anyway, so think of kind of those old companies, you know, like your Miners or your Caterpillars or your John Deeres, if you will. Whatever is old is new again, and all of that is going to be necessary kind of going forward. So even though it may look like there's not a lot of potential for growth going forward, there's certainly a lot of potential for growth going forward, particularly as this recovery from COVID continues and as society and demands change on a regular basis. So that's sort of the first takeaway that we share with our clients this past week. The second thing is corporate earnings are key and will continue to be the driver going forward. This environment, we believe going forward, is not going to be sort of the easy sledding of what we've seen over the course of the past decade or so, right? Where low interest rates really help to drive up pretty much all companies, if you will, sort of a rising tide lifting all boats. Now these days, it's going to fundamentally matter which companies you own by each industry. There's going to be winners and losers, if you will. It's not going to be a rising tide that's going to lift all tech companies or a rising tide that's going to lift all financial services companies. There's going to be some in those sectors that do quite well and others that don't. So it's going to be more important from an investing perspective to really sort of focus on those companies that you own. It's really going to be more about selection rather than just kind of following the markets, if you will. And similarly, and we certainly have talked at length about this on the program before, dividends become very important, right? Dividend payments rose by 20% over the trailing 12 months to about almost $2 trillion. So there's a lot of sectors in the market that have dividend yields above even 3%. So there's definitely some opportunities out there if you look at things more on a company-by-company basis. And then lastly, and I think this is an important takeaway, recessions are a part of the cycle. That's their job. The economic cycle has an ebb and a flow, and what the ebb of the economic cycle, the recessionary part of the economic cycle, it helps to wash out those excesses. Clearly a tremendous amount of cheap money, excess government spending, low interest rates, things like that. You simply can't have sustained period of growth without an occasional downturn to balance things out. It's normal, it's expected, it's healthy. There's nothing to suggest that this is somehow the end of the world or that you need to throw out your entire investment strategy. Recessions are a normal part of the economic cycle. So those are sort of the three key takeaways that we shared with our clients at Nelson Financial Planning this past week at one of our regular quarterly sort of financial educational events. We typically do those as dinner sessions as well. I guess here's where we would do a little plug for ourselves. If you're not getting those types of opportunities to hear directly from your investment managers, the folks that are picking the individual stocks in your portfolio, well, then we would say, why not? You certainly should be. And we've certainly been doing that for over 30 years at Nelson Financial Planning. Cannot emphasize enough the power of information and education, particularly paramount in uncertain times. One other interesting stat that we'll leave you with, rising interest rates have this bad sort of thought, if you will, that it's hard to make money as interest rates rise. And you've often heard the expression of, oh, you can't fight the Fed. Well, if you look at the data of the last 7 interest rate rising environments since 1977, so there's been 7 different times that the Fed has actually kind of done this and engaged in this kind of activity, the reality is that it's not the death knell for investment returns that the mainstream media likes to espouse. If you look at the rate hiking period since 1977, and there's been 7 of them, average return in the S&P 500, 12.7% in the year after those interest rate hikes first started. So think about that, 12.7%. That's a pretty good rate of return over time. And so certainly something to kind of think about, where it's not a situation where all is lost, even though interest rates are increasing. Same thing is actually true on the international side as well, a return of about 12% if you look at those prior rates. So certainly something to think about, even with rising rates. Return is certainly crucially important, and you can still find some and get some in the midst of a rising interest rate environment. With that thought, we will take a break and continue on the conversation here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So beware. The self-directed brokerage account option inside your 401k or similar qualified plan, particularly if putting your money there is being pushed by someone in the financial services industry. Welcome to Dollars and Cents. This is Joel Garris of Nelson Financial Planning. We are Central Florida's longest-running radio program, coming to you on a host of radio programs throughout the Central Florida region. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you subscribe to us on your favorite podcast channel of choice. So let's set the stage for exactly what we are talking about when we talk about the self-directed brokerage sleeve inside a 401k or similar qualified retirement plan. The reality is that it's a relatively new concept, if you will, that is inside 401ks and plan platforms that basically allows you to sort of take your money out of kind of the normal wrapper and slide it over to a totally separate wrapper that is, as the name suggests, self-directed. And ultimately, then you can step outside the plan and select your own investments, do your own trading, all of those kinds of things. And sometimes that's a good choice because, as we've said many times before on the program, there's certainly most plans these days are offering more and more limited choices, and a lot of these choices happen to be sort of these milquetoast, if you will, target date funds that certainly get too conservative too early in terms of the investment time period. So having that option certainly can make some good sense because it does afford you the opportunity to look for other opportunities, look for other types of investment opportunities inside your current platform. But more often than not these days, we see examples where that movement it is maybe not a good idea, and in fact not a good idea at all when it comes to being pushed or directed by someone in the financial services industry. Here's why, and sort of here's how it works, if you will. So oftentimes, most folks' assets are tied up inside of these plans, right? I mean, you're still working, you haven't retired yet, so the vast majority of money still sits inside these plans. And so you go see someone in the financial services industry, maybe a financial guy, a financial gal, whatever the case may be. And if they can't move that money to them, then they're not going to get paid. And so enter these self-directed kind of sleeves that provide some kind of an option for that financial person to get paid, because various investment firms have created these fund choices inside these self-directed sleeves that allows the financial person to get paid. Years ago, we were approached as well by one of those firms. We've certainly, over the course of the years, spent a lot of time talking with people about their options inside their 401ks, or if they are working for the state of Florida and happen to be in the investment plan, talking about the FRS, the Florida Retirement System Investment Plan, and the options inside of that plan as well. And like we said, a lot of 401ks have this self-directed option. The FRS, Florida Retirement System Investment Plan, also has this option. And so when we were approached, because obviously, been around a long time in the community and got the radio show and things like that. And so they said, oh, well, this is a great opportunity for you to help fine-tune the advice that you are giving people when you kind of take a look at what's in their 401k or what's in their FRS investment plan. And we said, okay, well, that's good because, we're not exactly thrilled with the fact that everything's gone to these target date funds. It's really, doesn't really give a very finely tuned investment approach when you're using that stuff. And, and then we kind of looked at who the investment managers were underneath the investments, and, it was good, reputable companies. But then, we kind of dug and we're like, well, wait a minute, how are you, this particular investment company, dealing with them? What, once you start getting multiple people involved, well, guess what then? There's a layering, and then anytime there's layering, well, then guess what? There is cost. So those costs came in to be about 3% on these types of investment options. And so in good conscience, we can't support something like that where it's 3% per year. I mean, that's almost annuity-like in terms of the expenses that are occurring on a platform that traditionally shouldn't have that excessive of experience of expenses. So for us, it was shocking to kind of see that play out. And the problem is, of course, as you might well imagine, that anytime your expenses are that high, it's a pretty big drag on your performance. So even though, okay, great, maybe I'm getting a little more finely tuned in terms of the investment allocation, probably better off just sitting with one of those boring target date funds that is not in the self-directed platform. Because if you're sitting in the self-directed platform and you're feeling a push by someone in the industry to do that and to go into some specific investments inside that self-directed platform, well, then it could be that they just can't wait for you to retire or you to leave your job, that they're so desperate for revenue as a financial company that they feel that they have to stick you into these incredibly expensive investment choices so that they can get paid now. Well, folks, as you might well imagine, our advice is to steer clear of that option. Don't do that. If your expenses are approaching 3%, I don't care how good the performance is, that's a pretty significant drag. And particularly if we're in a tougher climate going forward where it's not easy money days and it's higher inflation and higher interest rates, you really got to make sure that whatever the return is that you are getting, you're getting to keep more of it than less of it. And when you own an investment, doesn't matter whether it's these types of funds inside the self-directed accounts in a 401k, whether it's annuity, whatever the case may be. When you own an investment, the expense that you pay is always a drag. So make sure you're asking good questions. Watch out for these self-directed options that are in there because, my goodness, they can really be a drag on performance. Speaking of that, that's actually one of the things that we're going to be talking about at our sort of meet and greet luncheon seminar that we're going to be hosting here at the office on October 13th at noon, a little sort of meet and greet lunch where we're going to talk about some of the strategies that you can follow that ultimately are important to know during the course of times when inflation is high and interest rates are high. We just sort of touched upon one, so not to give too big of a preview for our meet and greet lunch on October 13th, but knowing the expenses, because the expense is always a drag in terms of what the net result is that you get to keep in terms of your actual return. So those are some of the things that we're going to be talking about at our meet and greet luncheon at the office on October 13th at noon. If you're interested in attending that, obviously we ask that you go to our website, nelsonfinancialplanning.com, and you can RSVP there. Or if you'd like to just do it the old-fashioned way and pick up the phone and call our office, 407-629-6477, you can certainly do that. Guess what? You'll be thrilled to know that we still have live people answering the phone. Yes, that's right. We still believe in that. So anyway, we'd love to have you join us for that meet and greet. Maybe you've always kind of wondered, hey, maybe I want to kind of get to meet Joel and the rest of the team at Nelson Financial Planning, but I haven't really necessarily had an opportunity to do that. Well, here is your opportunity. October 13th at noon. Register at nelsonfinancialplanning.com. Last week, we were joined by fellow certified financial fiduciary and IRS enrolled agent Christina Lamb from our office at Nelson Financial Planning, talking a little bit about some of the tax changes for 2022. I thought we would sort of supplement that conversation we had last week with one about some of the tax moves that's coming up, considering that here we are racing to the end of the third quarter, which means that we only got 3 months left in the year. Certainly some things to be thinking about as we look ahead to the next 3 months that you might want to consider as it relates to your investments and your financial strategy to help minimize your taxes, right? No better time to minimize taxes than when inflation is as high as it is. So we're going to be talking about that in this segment of the program. So welcome to the program. Of course, this is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Central Florida's longest running radio program, coming to you on a host of radio stations throughout the Central Florida region here on Sunday mornings. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web, with almost 25,000 downloads of our program. So make sure you subscribe to us on your favorite podcast platform of choice. Go to our website, nelsonfinancialplanning.com, to get directly connected to our channel on those various platforms, including YouTube, where you can see us doing the show each and every week. My name, of course, Joel Garris, certified financial planner and certified financial fiduciary with Nelson Financial Planning. So 3 months left, or a little bit more than that, in the year 2022. What are some of the tax moves that you can do or that you should be considering at the very least to do prior to the end of the year? Well, first and foremost, in a year that has been a volatile one, a down year, if you will, then there's certainly some opportunity to sort of look at your portfolio and try and see if there's opportunities to maybe save money on your taxes. So this works in a non-retirement account. It doesn't work inside of an IRA or 401k or anything like that, because all of that money is pre-tax money. It's tax deferred. It comes out as ordinary income. So this conversation doesn't apply to those types of accounts. But if you've got an account that's on an after-tax side of things, then something that we usually refer to as sort of a regular investment account, then here's how it works. Let's say that you bought 100 shares at $10 a share, right? And because of what's going on in the market, those 100 shares are now only worth $8 a share. Well, if you were to sell that position, then you would recognize a $2 a share loss that you could then use on your tax return. Now, the reality is that this is not a strategy where you want to really be out of the market, because the market can move very quickly, particularly during volatile periods of time. It can move up and down in very quick manner. So you want to find something that is similar. If you're using mutual funds in your portfolio, like we do at Nelson Financial Planning, then you can certainly easily sort of find something comparable from a performance perspective and make that shift. Typically, when you do that using a fund, there's no additional cost or anything like that, as long as you stay in the same fund family. Then you can take that paper loss, and now, because you sold the fund, you converted that paper loss to a realized loss that you can use on your taxes. So certainly something to kind of think about and look at. But you want to make sure you're not doing it and shifting like to a cash position, because certainly within a short period of time, you can always have the markets move up just as quickly. So that's kind of the background on kind of how it works and what it is. A couple of caveats. First caveat is that you can use those capital losses against capital gains. To the extent that you've got gains, you can use those capital losses up to offset those capital gains. To the extent you still have extra capital loss after that, you are limited to only being able to use 3,000 of those capital losses against other income. So you can still use some of the losses to offset other income, but you are capped at 3,000 for that. The other thing to consider is that if you're going to be able to want to use this as a loss, then you have to be aware of the wash sale rule, which says that anytime 30 days before, 30 days after, you can't have bought something that's substantially similar to the stock or the fund or whatever the case may be that you wound up selling to generate that loss. So a couple of caveats to just be aware when you're thinking about tax loss exchanges, things like that, and how it works is that It only really works outside of a retirement account, number one. Number two, there's a $3,000 limit beyond the capital gains. Good news is you get to carry it forward, so the excess capital loss doesn't disappear. You wind up being able to carry it forward. And then beware of that wash sale rule. 30 days before, 30 days after, you can't have bought the same thing. Otherwise, the loss winds up getting disallowed. Also, sort of on the list would be charitable contributions, right? Oftentimes, people make charitable contributions as the year winds down. Particularly think about sort of bunching or bundling them up in a single tax year. And by that, we mean if you're going to make a contribution next year, why not bring that contribution next year into this year, or similarly vice versa, because that way then you might be more likely to be able to itemize those deductions rather than just doing the same amount every year. Remember, standard deduction much, much higher these days. So sort of bunching or bundling those charitable contributions in the same calendar year may in fact help you be able to itemize one year and then go back to the standard deduction the following year. Also remember, if you've got a required minimum distribution, right, don't forget you got to take that out before the end of the year. It must take all of that required minimum distribution out by the end of the year. There's no exceptions to that. There was an exception in 2020. That is long gone. You have to take out your required minimum distribution. One option to reduce that, to sort of combine the charitable piece into this, is that you could do a qualified charitable distribution, which basically means that you take your RMD, send it directly to a charity, and then that offsets the tax implications on that. So certainly something to consider in terms of your RMD and charitable distributions as well. And then lastly, be aware of fund payouts. Some funds, again, these apply to funds that are not in retirement accounts. Some funds will still this year deliver out capital gains and things like that. So you might want to take a look and see if that applies to any of the investments that you own, because you really wouldn't want to have to pay tax on a capital gain for a fund that went down in terms of its performance for a calendar year. So certainly want to check that out. Typically in the next 30 days, most funds will generate out an estimate of what they think their capital gains will be. So certainly that's something to really kind of take a look at and make sure that that's not applying to you. Usually you see that on funds that kind of have a high turnover and things like that, whereby you may see the fund still paying out a capital gain. So certainly some interesting things to be thinking about in terms of some tax moves to make as we think about the end of the year 2022, unfortunately, rapidly approaching, right? So anyway, that's about all for this week's episode of Dollars and Cents with me, your host, Joel Garris of Nelson Financial Planning. If you like what you heard and want to learn more about our team of certified financial fiduciaries at Nelson Financial Planning, who can help change your life with a successful and cost-effective financial plan, go to our website at nelsonfinancialplanning.com. Fill out the Contact Us form to set up a free conversation, or you can call the office directly at 407-629-6477. Still have live people answering the phone. And remember, we don't believe in account minimums at Nelson Financial Planning, because our purpose is to help you get a financial plan with better results at a lower cost. Have a great day.